I think there are some unique things, to my observations of why Silicon Valley is a little bit different from a lot of entrepreneurial areas. Previous company we were working on, we started in New York, and New York has grown a ton as a tech hub and a venture financing hub and everything, but it's not quite the same. And I think that, in particular, the Bay Area still has a higher concentration of people focused on kind of that culture of failure. I think it's not a bad thing if you start a company here and it just totally fails. And investors don't look terribly on like, oh, you started this thing, it didn't work out, clearly I should never invest in you again. That's not the mentality, right? I think a lot of folks go, you actually learned a lot from that. You're probably an even better entrepreneur because you have learned what not to do. And hopefully that next time you've got a great idea, absolutely, you probably learned from that, right? And I think that is a very pervasive culture here, and more so than any other place that I've lived or seen a lot of entrepreneurial activity. I think the other thing too is that there's no doubt that even though some of that culture is necessary, another part that's very helpful is having financing, having companies that are important. And so, it's not, I think, a total coincidence that there's so many venture capital firms that are based in Silicon Valley. And, I think of, presumably any investor could invest in a company, right? But I think venture style investments are very different. If you think of that asset class, it's really different even from private equity or traditional kind of, other asset classes, in that the venture industry, and I don't know if the last speaker talked about some of the background of this, is kind of different in that the expectation is that 9 out of 10 bets is going to fail. You're going to get basically wiped out with most of your investments. But one of the 10 has to be so successful that it makes up for all the failures. So what does that mean? It means that you have to be incredibly risk tolerant. And basically, there's only certain types of companies that you end up investing in. So you basically invest in companies that have the potential to have humongous fast growth, but nothing else. And that means probably that a venture investor would never invest in a really great sandwich shop, because you can't just scale that super quickly. And so that's why, and I think somewhat paradoxically, you end up seeing a lot of people get really confused, there's so many good business opportunities. Why is venture capital only looking at these seemingly companies? And it's because they need to get that scale to make up for the 9 other failures that are just going to be wiped out in the investments. So what does that mean? Well, I think it means that you have a very weird, different relationship between entrepreneurs and investors. So, I think typically, how many folks here have started a company before? What's the back? Okay. Of you guys, did you take out financing from venture capital, or did anyone take in venture capital style investment? In this company? Okay. Gotcha. Okay. Anyone else? Did you guys pitch in any venture capital investments? Okay. And in those previous ventures, I think there's something really weird also where, one observation I have, and I will get to your question about what that relationship is like, but I think that understanding the venture capital industry is important to just contextualize what we're talking about right now. So most asset classes, if you're in private equity, if you're in I don't know, to name whatever traditional stock investment or something, if you get 7% returns, 20% returns, that sounds pretty good. Right? That sounds amazing. But remember the dynamic of most venture capital funds are not a single wealthy family or something investing their own money. They're funds that have said, hey, rich person, your family office, put $100 million into my fund, and I've got a fixed amount of time. In 5 to 10 years, I'm going to return that money to you. And I'm going to make money on usually a 2 and 20 model. I'm going to make 2% of my money every single year. If it's $100 million you take it in, I'm usually going to take about 2% of that, $2 million every year to manage my fund for the next 5 years. But then I'm also going to get 20% of all money in excess of that 100 million that I return to you. But I really only have 5 to 10 years to return that money to you. So what does that mean? It means that if I expect 9 out of 10 of my investments to fail, I need to be looking at almost exclusively really high growth companies. And I also need to find a company that's going to return a 10x return within 5 years, because I only have 5 years to do that. And so that means oftentimes the investments that I'm making have to have the potential to not just grow really big at some point, they need to grow really big within 5 years, which is a pretty unusual statement. You look at most companies and not a lot of them really actually grow that quickly in that. And so over the last 10 years, last 20 years, I think you've seen a lot of movement in the venture industry where they're taking more and more bets with larger funds in what used to be called kind of growth capital. So think about your favorite consumer business, when I don't know, ride-sharing companies were really becoming really in vogue. It's really risky to invest in that in a certain stage, right? Because that means I don't know how long it's going to take to get traction. I don't know if it's going to take 10 years to get massive scale. But if I wait a little bit longer and deploy more capital, I can probably just wait until that hockey stick of its growth starts looking really steep. And it's really easy to just say, hey, well, it's already growing. It's probably going to grow a lot faster. And that, if it's going to make it, it's going to make it within 2 years. If it's not, whatever, I can figure that out afterwards. And I think there's been this attitudinal shift where a lot of sophisticated investors have moved away from that classic thing of early stage investment to much more growth style investment where they want to write bigger checks because it's less risky than taking an undeveloped technology from the really early stages. So to your question, I think, what does that relationship look like? I think a lot of entrepreneurs have to be very, very mindful of what type of company they're building. Keep in mind that if you look at the American economy, let's say, does anyone know what percentage of companies are funded by venture capital? I'm gonna guess.
10%.
10%? It's actually high, it's about 5%. So you think about that, right? Like, the gross majority of companies never take in venture financing. And it's a very unique product because the second you do take venture financing, you're on that clock. You basically have 5-10 years before you have to show that your company has the potential to make it really, really big. Otherwise, you're going to get a lot of pressure from your investors to say, what's going on? Like, I need to show my LPs that this is going to work out really well. And if I don't have traction towards that, that's really difficult. So I think, nowadays, really sophisticated entrepreneurs are really good about managing that dynamic. And they understand, I think, a lot more, okay, what are the pressures that my investors are under? If I am an early stage venture capitalist, what am I worried about? What are the questions that these rich family offices I've taken financing from worried about? And if you look at 2021, 2022, it's a pretty weird time around technology stocks. Most venture funds that were built around that time made so many investments in just humongously inflated private valuations that just cannot be justified. And so a lot of the venture capitalists are facing tons of pressure from their investors saying, look, I don't believe you that you're going to really return this fund. I put $100 million into your fund, you've invested it, I think you've lost huge markdowns towards that. And so some of that pressure certainly has gone on to the entrepreneurs to say, look, do you have some shot right now to turn that around in the next 5 years? Something. So the folks that have raised money over the last few years, I think a lot are dealing with this sort of dynamic. I think you're seeing a lot of entrepreneurs who raise capital around that time and are putting off raising additional capital until they can show, oh, hey, I have the potential to have an even higher valuation, some positive story around this, because they're trying to manage that expectation.